Nobody should pretend they have a crystal ball. We hold, and we shared in December, a more cautious, optimistic tone.
What would you like to see Canada achieve this year?
Urgency. My compass would be that we have modeled for more pain.
Canada's challenger bank was on the ropes in 2025. We speak to the new CEO of EQB, who came into the role after the sudden death of longtime CEO Andrew Moor.
It's heartbreaking to see a tragedy like that play out, and it brings perspective.
Chadwick Westlake is less than 6 months into the role, and he's already shaking things up.
We're buying back every day because the stock is also very, very discounted.
Even still, with the rally?
Very discounted.
There were challenges within the business itself. Why did you take the job? As a potential takeout or go private? Is EQB next? The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Remember, all month long we are doing our swag competition. If you've got a funny idea that you think would make a great finance meme, better than the ones we already have, but we are running out. We've got our In the Money mugs, of course. We have our Smell Like a Man in Finance candle, but I know you guys are creative, so comment wherever you're listening. And we're going to take the best idea, and I think producer Jillian, she's greenlit this. So we're going to take the best idea, we're going to turn it into swag. We'll, of course, give it to the winner, and we'll use that for our next swag giveaway. This episode is a little bit different from our usual portfolio managers. We've got a CEO interview. EQB was the worst performing bank last year. Now, between a slowdown in housing, a spike in provisions for credit losses, and the sudden death of their longtime CEO, there was a lot to absorb. But in this sector, the banking sector, there's an old saying, worst will be first. That's the tendency for last year's worst performing bank to outperform the following year. That certainly worked out for TD shareholders in 2025. So to understand whether EQB will be a winner in 2026, we spoke to the new CEO, Chadwick Westlake. Less than 6 months into the job, he's already made some huge changes. Some of them are difficult. There was a big layoff announcement. Some of them were positive. He announced a huge deal to buy PC Financial and be the exclusive financial partner of PC Optimum. That deal alone sent the shares surging. Now, before we get into the interview, I want to disclose that the podcast has sought to do business in the past with EQB. And while we currently have no business relationship and we're not compensated in any way by EQB, that could change in the future. Now, I didn't send my questions in advance and no topics were off limits. And I conducted this interview with your best interest at heart. But running your own ad-supported podcast can blur the line, so it's always my promise that I'm upfront with you about any potential conflicts. So with that out of the way, let's get into it. Chadwick, thank you so much for joining me.
Thank you for having me, Amber. I'm such a big fan and excited to be here.
And I'm excited to chat with you. I haven't spoken with you ever, really, but especially because you're fresh in the role as CEO of EQB, which I know the tagline, the Challenger Bank, which I think is like just a great sort of short, sharp slogan about what you're trying to be. But for people who are unfamiliar, What does it mean to be a challenger bank? It's small compared to the others, the big five.
Yeah.
But what does it mean from a culture perspective, from a business perspective?
We're Canada's challenger bank, importantly, too. We're about Canada. We're proudly Canadian. We only focus on serving this country. We're literally trademarked Canada's challenger bank. And today is the 10-year anniversary of marking that Canada's challenger bank brand with EQ Bank.
Happy anniversary.
Thank you. And happy anniversary to in the money and the huge success over the past
Thank you.
year.
Yes, 1 year since putting out our first episode.
It's extraordinary. Challenger brands.
That's right.
So by design, a challenger is meant to disrupt, to bring different options, to look at traditional models and figure out, you know what, is this really the way to do it? Can we bring more innovative products? Can we bring lower fee products in a more efficient way? How do we get closer to customers? How do we bring new ideas without old infrastructure, being more digital, being mobile first, really being customer first? So it's really about disrupting and changing the game.
It's also a different style, maybe, of lending. You typically lend to people who get shut out of the big five, entrepreneurs, immigrants. You've got exposure to the housing market that is higher than some of the other banks.
Yeah.
So I hear you that you're trying to disrupt the other banks, but you're also doing things that they're just not willing to kind of take on for whatever reason.
That's right. Yeah. I grew up in banking. I saw how the large banks work. And you're right. Sometimes it can be about, do you fit into this box? We're about, how do you relate and understand Canadians and every customer uniquely? So we underwrite every single deal. We understand our customers well. And the mortgage side, about 70% of our customers are borrower for self. And that can mean many things.
What does that mean?
Yeah, that can mean, it could be a doctor, a dentist, somebody that's in media, a truck driver, a broker. A lot of people want non-9-to-5 jobs. And if you don't fit into that standard 9-to-5 box, it's a little bit harder to operationalize that in a big bank.
I think people don't understand, that access to financing piece. I have an example of that for a while. Like, my credit card company has been saying you can boost your limit. And as a sort of self-discipline thing, I was like, no. I like to keep it low so I know if I have to pay it off, if I get too high. And then I started my own business and I was like, gosh, I could really use that higher limit.
Yeah.
And then what did they ask me for? Cool, we'll give it to you. Can we have your statement of employment? And I was like, oh, I don't have that anymore.
Yeah. So it's different. You need to underwrite. You need to understand how to do that. And we've been doing that for 50 years.
I think that's important because, this is a type of lending. Canadians love their banks. They love to invest in banks. And part of it is kind of risk averse. And you do play in a riskier area, not outright risky, because I know you'll talk about the parameters you put around it. But that long history is important. And I think it's important to talk about how you came into the role as CEO. You came at an incredibly challenging time with the tragic and sudden passing of the CEO at the time, Andrew Moor.
That's right.
Who'd been the CEO for 18 years. You knew him. What was that like? Talk to me about what that period was like, because it's less than a year ago.
It is less than a year ago. I've been in the job for about 4 months now. I was with EQB originally for over 4 years as the CFO. Then I left to help with a technology company, OpenText, another proud Canadian company. And I was always very close with Andrew. He was a trailblazer for Canadians, for disruption, for being fearless and courageous to help bring change and promote open banking, promote new ways of banking in a country really dominated by the oligopoly. And he was very much about humans. So for somebody that was a friend, a mentor, close with my family, it's heartbreaking to see a tragedy like that play out, and it brings perspective to everyone's lives. Right?
And you have to understand kind of the personal toll that takes.
Yes.
And then you have to come into a business. What were those early days like? What was your first priority?
Stabilize, understand, listen. Listen was one of the first things I did. I joined when we were reporting a quarter, and then I had been gone for about 6 months. And then you come back where they hadn't actually replaced me as CFO. We didn't have a head of personal banking, and we didn't have a CEO. And we were right into a quarterly cycle. So the first step is, what's actually happening? How do you help stabilize the company and listen? So I was right across Canada, listening to every employee, listening to our investors, listening to all of our stakeholders. So at first it was trying to really understand what's happening and why is it happening, and then move fast.
Why did you come back? I mean, other than the CEO title, that's a good title, but You had just left to be the CFO of OpenText. You were leaving banking.
Yeah, I was.
You were going into tech, and you had just done that. And as you mentioned, there were so many challenges. You had big vacancies in the C-suite. There were challenges within the business itself. Why did you take the job?
No greater opportunity. I care deeply about Canada. I'm a very proud Canadian. I was born in Kingston, Ontario. I care about this country. My job has always been in banking, essentially. And there's no company like this. So there is legacy and there's potential. And I don't see a bigger platform than Canada's Challenger Bank. So I came back because I care about the people and the purpose. It's really this purpose that you can't find anywhere else.
Let's reflect on last year. And again, you were there, and then you were not there, and then you were back then. So you have to, first and foremost, from a culture perspective and operational perspective, you've got a CEO change, which you hadn't had in 18 years under tragic circumstances. But then also the business, right? There were concerns about housing. There's concerns about immigration. And the stock was under pressure. What was going wrong in 2025 as you stepped into that role? And I asked that because I know CEOs don't like to talk about it, but I asked that because I wanted to get a sense of how did you understand what your priorities were going to be?
Focus. What I find very frequently is companies can lose focus. And when you don't have a CEO change in 18 years, you can actually lose focus. Just because it's that long doesn't mean everything's going well. And I wanted to reset the baseline. I'm all about clean pages. Even on my desk, I always have a blank piece of paper. What's your clean page? And I write out ideas fresh, new. And that's part of what we had to do, even after 18 years. So focus on a few things that matter. And EQB is smaller, but it's growing quickly. Even 5 years ago to when we close our upcoming acquisition, revenue will have increased 5 times. In our time, we tripled the market cap. We grew a lot. So it's a bit of a first thing, listen to the employees about what's working well, what's not. Listen to investors, listen to our stakeholders. And then I try to focus on cutting some things out. Too many companies focus on addition, not on subtraction. So what are the few things where we're winning, where we have a competitive advantage, and focus our energy there? And kind of had to shut down some pet projects and really refocus the company around a few key priorities.
What's an example of some of those pet projects that just didn't fit?
Well, some of them will come out a little bit more, but I'd say there's a lot of little experiments in services and digital and in lending where we weren't competing. Because for us, a North Star is return on equity. We're a public company. On a 10-year basis, we tend to have top 1, 2, 3 total shareholder performance of North American banks. And if something doesn't hurdle at 15% plus ROE for us, then we shouldn't do it. And we had things that weren't doing it. Even things like insurance lending, for example, we stopped on because we weren't competing as well. So I said, no, let's stop that.
And we like to clean up the jargon. So ROE is basically just this measure of how effectively you're using shareholder money to make profits. So 15% and higher means if I invest $100, you're making at least $15 in profit. So it sounds like that's your North Star. You had to make tough decisions in expenses. But I want to talk about specific markets that were challenged, and maybe you don't think that they were. You know that whenever the housing market cracks, EQB is a favorite punching bag. It used to be Home Capital too, but now that's gone private. What did it look like for EQB? What is going on in the housing market? Because I know your provisions went up. So you are setting aside money for a market that is in distress in some areas.
Yeah, by nature, right? You lend, and in some cases you're going to lose money. It depends how you price it. I generally view EQB as a reflection of the Canadian population. But we're actually very conservative lenders. Just because you lend where others might not lend doesn't mean it's more risk. You price for it, you underwrite. But a lot of our borrowers are very resilient. And we lend in high quality tier 1 markets, urban Canada. Where is the population growing? Where are their jobs? We're not lending in necessarily small towns where there's greater risk to employment. And these are high quality borrowers. Our average Beacon score is, so the credit quality scores, but about 710, 711.
How does that differ from a big 5 bank?
They would be higher in the 700s, mid to high. But our loan to value ratio, so how much we lend on the value of each property, is also on average 65%. So that's pretty low. So great quality markets, good borrowers, resilient borrowers, in growing markets, that reduces the credit exposure more. I think, Amber, a really important point is that if you look at the trend since we've been in single family lending, we've had the lowest credit losses of every peer bank in Canada. We don't lose money often. And that's what threw some people off, I think, that last year was some provisions and some losses in single family, which is natural, but it's very, very isolated to a couple boroughs in Canada where prices declined by more than 30%.
And I heard you say I don't know if you remember it offhand, but it's the number of homes versus the number of loans that you've made. It's like 60,000 loans and like 50.
That's right.
So
that's right.
Just when people understand what distress means in banking, for banking, that is what distress is.
Well, that's the thing. It's small in the context of the bigger population and isolated reasons why if somebody had that happen in some sectors or segments.
So that's interesting because I've heard you talk about like this loan by loan approach. You came in, you looked at everything loan by loan. What is our risk? Understanding that, because a lot of people will just with a paintbrush say it's systemic. I mean, even in the Globe, and I know this is not your market, but the Globe will say, I think it's 40% of all real estate funds are gated now. And again, you guys play in a different sandbox, but it's all housing. It's all real estate exposure, whether it's condo or otherwise. So does Canada have a systemic housing problem?
I don't believe so. Outside of supply, and the trend you would have heard about, and many people speak about is the fact there's no Canadian housing market. It's those micro markets. And even for those 50, 60, that's a few specific areas. So I don't believe it's consistent across Canada. We still believe we need more supply. We need, yes, more affordable housing. We're part of that solution. We're big in affordable housing development as well, right? For funding of that, for CMHC insured on the commercial side. I don't think we have a systemic issue per se. And I don't believe EQB has the loss profile that people perceived us to have as well.
So you brought up provisions to deal with some of those higher than normal, but still manageable loan losses. Do you have a sense of what 2026 could look like? That's usually if we're trying to figure out really what does a bank think about the future, it's what are they setting aside for loans that could go bad? Yeah,
I'm a pretty practical person. Optimistic by nature, yes, but practical. And what I learned last year is nobody should pretend they have a crystal ball. You can't truly predict what's going to happen this year, but we learned a lot. We learned how to deal more with volatility. We learned how to be even stronger lenders. And we hold, and we shared in December, a more cautious, optimistic tone. We're on the ground. I'm not seeing significant traction for everyday homeowners yet. I'm not seeing a lot of movement in the market. I do see resilience. We don't expect housing prices to decline as they have. There might be some more come down, more probably on the condo side than the semi-detached or detached. But we have room for some optimism that when you think of why do houses even sell? People get married, people get divorced, people have kids, life changes, families move to Canada. Things have to move. That dam breaks at some point. And I think that pent-up demand is going to move. And the recent rate reductions haven't really fully even moved through the economy. So there's a combination of factors that I think by the second half of next year, things will be moving more. Even to get the certainty that rates might not come down further will get people off the sidelines more. I think that's the big debate around your outlook versus investors right now is you do seem to have that second half of the year optimism, and you are calling for high single-digit growth. Total loans under management, high single-digit. You're calling for growth. And if there is skepticism about the EQB strategy, it's like, why are you so optimistic about that? Most analysts that I speak with and read about, they're not so sure that we're going to get that on housing. Trade is a big issue. We'll also talk about immigration. But, we just have less of all those things that have been traditionally really good for your loans under management. Diversification matters. The businesses, knowing them really well matters. Take an example, reverse mortgages. I think it's a wonderful business for Canadians. There's not a lot of education in Canada. That business for us increased another 35% last year. We're now at about $2.7 billion in loans under management. That has very low risk profile, and there's big demand. So we can grow business like that again further. And that's for Canadians 55 plus, particularly 60, 65 plus. Those are loan to value ratios in the 30s and 40s. And it's a great cash flow management tool. That's a great I think, a better alternative to HELOCs.
I know.
So a product like that can
kind
grow.
of like a negative connotation.
They don't understand it well.
Yeah.
And what might form is because the large six banks don't want to operationalize towards that. We can, and there's a huge market there, and it's a product that Canadians deserve. So you have products like that will continue to grow, that are needed, that are purpose-driven. You get the loans under management growth. The commercial side, so I mentioned commercial, so Canada Mortgage Housing Corporation, the CMHC insured, we're the largest securitizer of affordable housing funding in Canada. We're bigger than RBC. That's a huge growth opportunity because that ensures there's more affordable housing for everyday Canadians. Over 85% of our commercial bank is insured by the Canadian government. That has big loan balance growth. That's going to continue. From the last Canadian federal budget, they increased funding for that. It's all around the CMB. That increased from 60 billion to 80 billion to help funders, help lenders do even more. So the government wants us to do more there. That's going to result in loans under management growth. And that gets people into affordable housing as well. So there's products that will add to that growth.
So you can grow in the markets that you're already in, but
yes.
You also said diversification. I think something like 95%, and correct me if I'm wrong, of your loan exposure is to real estate?
Yep.
What does that look like in 5 years?
Different. We have businesses that we're thinking through the prioritization on, like equipment financing, for example. We're doing less there. 5 years, the picture of EQB and Canada's Challenger Bank will be dramatically different. We're absolutely expect to be more than double, if not triple again, in another 5 years. And the portfolio makeup shifts. So when we close our partnership and acquisition of PC Financial, that will bring about 2.5 million Canadians into our portfolio. And that adds credit card assets, for example. We don't compete in that space today. So that starts to shift the loan mix, but it's also the makeup of mortgages might shift as well. Where today it's more the uninsured single family through our broker partners, because 1 in 2 Canadians get a mortgage through a broker, and we care deeply about brokers as the best way to get a mortgage. But that mix can shift because one of the aspects of Canadian banking competition is capital treatment. The regulator hasn't welcomed a new advanced internal ratings-based capital treatment for a bank since, 20 years this year.
Which is a way of saying it's hard for small businesses to get loans.
It is, and it's hard for a lender like us to do it even in a more fair way.
Okay.
For pricing, for capital treatment. So if that changes, which it should for us, then we can do even more lending. That changes how we can compete. That changes how we can price. That changes the whole portfolio.
And like, can we talk in terms of numbers? Like, what does 95% come down to, and what makes up that?
We'll share more of that at the Investors. We're going to hold an Investor Day later this year.
Give us
With the next time I come on. But it's what I want to make sure is very clear, because clarity should come with a challenger bank. Focusing on doing a few big things really well matters. I think fintechs do often one thing really well. Large banks try to be everything to everyone. I want to do a few big things really well. And that comes with clarity of what that means for a Canadian and what that means for a shareholder.
People will want to know, you don't see anything systemic in the housing market, but do you see more pain? Is 2026 a year of healing or more washing out?
My compass would be that we have modeled for more pain. I think a lot of Canadians are still struggling. We care about them. We want to help them. That's why we have many no-fee and low-fee solutions. We don't charge all the bank fees that everybody else charges. We lend to make sure people can get homes. There's nothing that gets me more excited than to go home and see, for example, my 7-year-old son to say, we helped somebody get a home today for the first time. That matters. That's why I do a job like this.
Does he care, the 7-year-old?
He does. He gets very excited. He came home yesterday. I just got back from a trip. He came home and said he got 10 out of 10 on his money test at school.
Good for you.
So he's learning, and that matters because they care. This is so purpose-driven. And some of them are struggling. They're absolutely struggling, and we've modeled for that. So with the credit provisioning that we took in Q4, we continue to expect higher unemployment and some struggles with housing prices and some traction for a little while.
And what does that look like? For years I've been talking about the mortgage cliff, 2026. It's here. I can't believe it. But all these people who got 5-year mortgages at dirt cheap interest rates now need to renew. And so with all that strain and stress in the system, the fear is that everyone's going to be renewing at these higher rates. And even though they're lower because of rate cuts, they're not as low as zero. What does that look like at EQB?
For EQB, it's different.
Why?
We average about a 2-year duration. People
So
come
you've
in
already had renewals.
We're here to help. As people renew now, they're actually going to renew to lower rates. That's a great advantage. And our book has turned over from those vintages because it's a lot of that 2022, 2023 timeframe when somebody got that better rate. You've already renewed with us and you're going to renew to a better rate and a more competitive rate.
What was your experience then from 2020 to 2022? Like how much of a shock was there and what lessons did you learn about people's ability to withstand that?
It's people, but it's also property appraisals. So we've increased that frequency of appraisal to make sure, because those were moving pretty quickly. But we learned we're good at what we do. We're really good at it. And the stress that came up is what came up last year. So in all of that, of our years of lending expertise of helping Canadians, if we had some losses, not a lot, I'd say very, very thin amount of losses, 50, 60 properties in single family, for example, that's the strain you see because that is that 2022, 2023 vintage. It was already low loan to value ratios, but those are cases where the properties happen to drop as well in value. So it was unique that way, but we've been looking to see if it's systemic and it's not. But that's an example of where it can come up. And we tend to see borrower for self-employed people having more resilience sometimes than standard 9 to 5 as well.
You don't have a choice.
Yeah, we've learned a lot about it. So we believe in it. That's why we put our capital there.
Okay, so we've talked about real estate. Yeah. One of the other things that people have questions about is immigration. You also have a big book of business that is for immigrants that don't have the years of, payment history or whatever, corporate history in Canada to show a big 5 bank. So they often turn to people like EQB. So that's been a growth driver. Now that it seems like immigration has basically been flatlined, what does that do for your ability to deliver on your growth targets for next year? For this year, it's 2026.
It's all within the guidance that we provided. It's that nuance where when people think of new people joining Canada, which we welcome, is incredible. Oftentimes, it might start with affordable housing. So you might come and you might rent for a few years as well. That's why we back so much affordable housing, to make sure you can get an apartment or a rental place to live. Then maybe after a few years you're starting a business. That activity can continue because, again, it's not just about newcomers to Canada. It's about existing borrower for self. So it doesn't change our growth curve in any meaningful way from our perspective. And it's all within that guidance. And we believe either way, if we have a 10-year history of that return on equity, that ROE being 15, 16%, we believe we can continue to do that in the future. So that's one of the indicators that we think there's a lot more we can do for Canadians, even if population's declining. That's not the key point. The key point is people want different choice, an option, and a better deal in Canadian banking. That's where we'll grow from.
Thank you to our partners at ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, you've been very patient with me. You've let me ask all my questions before we get to PC Financial, not because I'm not interested in it, because I know that's an easier victory lap for you because the market loved it. Yeah. You announced this deal to buy PC Financial and become the exclusive financial partner of the Optimum Rewards program through Loblaws and Shoppers. You did that, I think $800 million was the consideration there. As you said, access to 2.5 million customers, $4.4 billion in receivables. High level, why is this so game-changing for EQB? Because, to be clear, for the stock, it was under pressure. It was really lagging. And then this was a catalyst to your stock clawing all the way back. Now I think you're within less than 10% of an all-time high.
Couple points. So EQB's model was a very strong model either way. This is a defining moment in Canadian banking for Canada and for Canada's challenger bank. We've been doing it year after year. The stock was under a bit of pressure, I think, with uncertainty. That was a lot of change for one company that's proven to be resilient. We've closed those gaps. I also restructured the company for the first time. And what I was saying on strategy for a while is that we were going to add payments, we're going to add wealth, and we're going to strengthen our capabilities, and we're going to reignite the core franchise. There's a few things we were going to do. This was 100% on point with the strategy that we had been communicating. And this is bringing two challengers together in a dramatically different way. This would literally make us one of the only omni-channel challenger banks in the world.
Omni-channel meaning?
Multiple channels. So before, a lot of challenger banks were digital only. Now we'll operate pavilions at a Loblaw stores across Canada. We'll have an ATM network. It's sort of that advice
and credit cards.
Model. Credit cards, absolutely. That's where a lot of our customers said, if you have credit cards, if you have wealth, we'll do more business with you. So that's been a strategic priority for a while. And we examined for a while, how do you get there? It's very difficult to build that business, especially to build it without something that matters more than just a card. It's not just about lending. This is about the payment ecosystem. This is about loyalty. This is about things that matter to Canadians. How do you get that currency? When you use a product, how do you get something back?
And so it doesn't close until the end or like sometime in the back half of 2020.
Sometime this year. Yeah.
And do any of your forecasts that you made, call it in December, include the benefit, or you'll have to update once that's closed?
We'll update. It's all on top.
Don't worry, I know the laws enough that I won't ask you for it now.
We had some pro forma, right? This more than doubles our revenue, 4 times increase in customers. This is about scale competition in Canada. For what they have on their product shelf, for what we have, you add these two together. This is why it's that 1 + 1 = 3. And people say, are you sure you're a CFO? I said, yeah, I'm pretty sure 1 + 1 = 3, or in some cases, 1 + 1 = 11 here. This is shared culture, mission, alignment, care about the country. When you add these two together, this is game changing in Canada. This is game changing like we've never seen before. People are excited because they didn't see it coming. This is radically different for a challenger bank, not only in Canada, but anywhere.
Was this in the works before you came?
We had talked about the concept. So we've been exploring for 2-3 years. How do we get into payments, especially, and wealth? I'd say Galen Weston and the Loblaw team were looking at, what do they do with PC for the future? How do you build that? They were looking at options. We were looking at options. We aligned in a conversation.
When you were there as CEO?
CFO. We aligned. Okay, we had a conversation around November, December last year. Then it was sort of some light conversations, everyone exploring very quietly. But when I came back, even this summer, when I was going to come back, I said, this is the deal we need to do. I have a tremendous respect for those companies. It's the best retailer in the country, a huge respect and shared cultural alignment. And we immediately got into conversations and we negotiated all that in the past several months as very thoughtful partners. But we, as Richard Dufresne, the president and CFO of George Weston and the CFO of Loblaw, said, we kind of dated for a while to get to know each other because culture matters. And this is about change for Canada. And then we really picked up the pace and got married in December.
Again, the questions are, everybody I think is on board with 1 + 1 = 2. And that's what your pro forma shows.
Yes.
The 3 part is where there are some question marks. What does that look like? Do you start offering rewards, through some of your other platforms? I believe PC Financial they've done this before, sort of. They've had a bank relationship with CIBC. Like, do you understand how meaningful it was for CIBC? What kind of growth they saw that is a good parallel to what you might be able to get out of it?
Often I hear people talk about the CIBC as if it wasn't successful. It was actually very successful. It was very successful for them. It was very successful for Loblaw. It was more of a prioritization globally, I think, for CIBC at the time. And CIBC is a wonderful bank, growing really well. And with Loblaw, they wanted somebody to focus and partner with that's very focused on Canada and on their stores and that PC Optimum partnership. With CIBC, they generated tens of billions in mortgages, deposits. It was working well. So it's for other reasons that it didn't continue. And it's very important to have that shared cultural alignment and shared focus on this country. And that's why I think it can be different this time.
How did they generate that? I do remember actually going into Loblaw stores and I see those CIBC tents in the corner, and I would just avoid them. I'm just trying to get bananas, not sort of a credit card. How effective is that as a sales tool? And what are the other ways, beyond accosting people at the grocery store?
It matters. What matters is something you've said, and what I think about in large banking. Again, I spent almost 2 decades in large banking and had just about every job you can have. You have branches, and those branches are on corner of X and Y. I think it is important to be where people are. So as much as you don't want to go and you're there. And a big problem I was trying to solve for and thinking through as a new CEO, how do people even know we're here? Canada,
no branches.
No, it's digital only, or we work with brokers. And Canada is the most profitable banking sector in the world. Canadians are too complacent about banking. It's very true. And I say that as a proud Canadian. It's just, it's too much work. And then we're trying to bring those better options. We're a Schedule I bank. We're only behind National Bank. We're the 7th largest bank, over 140 billion in managed and administered assets. We also have an asset manager, trust company. We support credit unions. We have a lot of things. But we needed to make sure we were even present. And where some of the three comes in and why this can work, Amber, is we're right there with the brand. We're right at your cash register. You can see our brand. And one of the big anchors now is we have the pavilions, the ATMs, but PC Optimum. There's massive power for
We love our rewards.
Yeah, for about 17.5 million Canadians. This is the #1 loyalty program. You might use it at Shoppers Drug Mart, any of the Loblaw stores. Remember, there's tons of banners of Loblaws across Canada, even pumping gas at Esso. There's everywhere you can use this. And we will build this into our other banking products. We will make sure you can generate a lot more PC Optimum points and use them. We're the exclusive financial provider of that. So you get a digital. You want to use it because of the points, because of the no-fee, low-fee products. And now you combine that with EQ Bank products. You can have it all and be where you are. Even if you want to rush by when you're getting your milk and bread, you're there. And you might pick up a brochure. But one thing I'm designing in the word for 2026, I've said to EQB, is reimagine. That's our right and privilege and opportunity as the challenger bank, is reimagine that experience. So I don't want to just swap the logo from PC Financial. We're getting an insurance company as well as the credit cards in the bank. I want it to be about reimagining why you might want to stop in. And that's what you might see. That's the challenge I have, is what would make you want to stop in and matter to your family? Is there a certain interaction style? Is there something trusted you can do? But you can do it while you're there, not have to stop in at certain hours for a branch. You're there when it matters to you. And then 80% of Canadians don't know we're here, even though it's the 10-year anniversary for EQ Bank today. My bet is when this closes, we become a household name and we matter to Canada. And that's why it's just starting.
I mean, you're the 7th largest bank in the country, but just to give people perspective, the market cap is under $4 billion. The next smallest bank in National is at $68 billion. So there's so many companies you could fill into that gap. It gives you a sense of like the big five versus EQ.
Yes.
Which I guess also, if it's so lucrative, why not the other banks? Like, why don't the other banks want access? Because you're right, Optimum is such a successful loyalty program. Like, why weren't they in the room challenging you, the challenger bank?
For PC Optimum?
Yeah.
They weren't invited to the room.
I guess that makes it easy.
Yeah, they weren't. That's really important. These are challenger missions. This is a belief in this country. There's a belief in a better way of banking. And think of even the members of the board, the teams at George Weston. Think of the leadership team there. They built something that they care deeply about. And the customers of Loblaw, there's millions of them, and these are the best customers of PC Financial. So this is a shared mission. And they did have a great partnership with CIBC, but this is about them also having a strong role in EQ. So a couple of them will join our board. They're going to get 17% of our company at closing and be able to buy up to 25%. So they're going to be very influential, important partners to ours as we help build a better Canada.
And I do want to talk about that, but one of the concerns, if there are concerns about just anytime you buy a credit card portfolio, you even saw this in like JP Morgan, which got the Apple credit card portfolio, your provisions for loans that could go bad, they go higher because you need to deal with the credit quality risk. This is unsecured lending.
Yeah.
And it's consumer spending. Right. So we're nervous about both of those things right now. You just told us, right? Canadians are strained. How do you think about how that affects your risk profile? You've talked a lot about you think it's great for growth, but what does it do for your risk profile?
We're great lenders. We understand.
But a credit card is different.
No, it is, but people are people. And we understand the alternative space. We understand how to underwrite, and you price for it and you accept it. So you always have to price for what you're going to lose. The loss rates, the PCLs in this business are a little bit more similar to, a large bank credit card portfolio. And this credit card portfolio is, I think, 50% bigger than National Bank's credit card portfolio. It's a large portfolio, but it's super prime quality. So if you think of kind of those credit scores, these are people that would be at the top in the country consistently. They're actually a higher proportion of the portfolio pays back their balances every month. That's why the receivables are only 4 or 5 billion, but it's 32, 33 billion in spend. It's as they use that card, then we generate interchange fees as well to make.
So that's interesting. I mean, I don't know if you were able to do this, but like the Venn diagram of people who have this credit card and are EQB customers, is there no meeting in the middle? Is this like basically access to 2.5 million high quality borrowers that you wouldn't have had access
effectively
to?
I've joked lately before. I think we have higher overlap in employees than customers. So it's net new opportunity, and where you get economics for banking work in a different way. It's also those deposits you might make. So there's a high propensity of these customers that might want a great everyday rate that we offer and a great digital experience with great access to it. So they might bring some deposits and savings over. As we add in wealth, they might do that. They might want a mortgage. So the overall economics change, and that's why for all roads lead back to EPS growth and return on equity for us. So even with a higher provision, the whole economics shift in a very constructive way.
You mentioned that Loblaw now is one of the top shareholders and can become even bigger.
Yes.
Through this transaction. And then one of the other top shareholders is Stephen Smith.
That's right.
A billionaire trailblazer in this space. He bought Home Capital and took it private. So that's another way that EQB is different from the banks. The banks are widely held. Probably everybody owns the Canadian banks. EQB is closely held, concentrated now by two very wealthy, Canadian institutions, but Canadians as well. What does that do for the structure, your decision making, your accountability? What do investors need to understand about 40-50% of the business being held effectively by two entities?
And they should be excited about it. Stephen Smith is a brilliant Canadian who's done many great things for this country. He's invested and bought many great companies. He believes in the housing sector. He is completely passive. So he has no involvement with the company, zero. No board seats, nothing, because he operates a competitor, but he believes in our business. He was buying stock right through to before the announcement because he's not part of this transaction. So if anything, they should take faith that one of Canada's proud entrepreneurs that's helped build a better country loves this company. The George Weston company, Gannett, all of them, they believe deeply in this company. What's going to happen is more people are going to want to buy the stock. From my view, the liquidity of the stock becomes a little bit tighter, but you can get all the shares you want, and it becomes more limited because we're buying back stock every day. We've bought back more shares since I've joined than our combined history. We're buying back every day because the stock is also very, very discounted.
Even still with the rally?
Very discounted. Very discounted. And you can look at that even just drawing a linear line to the large 6 PE multiples and price to book values. We're very discounted. Yeah, because we're such an emerging story for Canada. People should be excited about that some of the most astute investors in the country love our stock and they're buying more by the day. We're going to buy it. Obviously, the Western's going to buy it. More people are going to buy it as they learn about it. And this does not even capture the full potential of what we're building. It's far from it. So discounted with a great operating model is a pretty unique opportunity for Canadians. The
other thing that kind of concentration of ownership does is, there's been so much M&A in Canadian banks that we're almost running out, right? Now Canadian Western Bank is gone. RBC did HSBC. Scotia, went into the US in a larger way through a little bit of an acquisition of KeyCorp. They bought a stake in that company. And last year, before you came on board, I remember there were analyst reports saying, well, is EQB next as a potential takeout or go private? Does this change that conversation?
It does. What we're doing right now is very important for Canadian banking. This is truly about competition. Competition it's almost a buzzword these days. And I believe this deal will be very welcomed and is going to be very welcome because this actually creates more scale. Scale is more vital than people like to recognize in banking. You need those economies of scale. You need the customers. You do need some of those synergies to be able to offer more at better pricing, better products. This builds scale. Some of the other transactions reduce jobs. They add scale to the big 6, but that doesn't mean it's bringing more choice. It's literally going to be down to really 7 big publicly traded banks. So I think it becomes more vital that we have our independence, that we bring more options. I think there's always people guessing that we'll be a target. Every year at the bank conferences for investors, there's one last bank, right?
That's right. Yeah, and now Laurentian is gone too.
Exactly. So there's 7 of us. So I think it's more important than ever that we grow and we scale. We have lots of capital. We tend to be one of the best capitalized banks in this country as well. We always operate with great capital, great growth. So we're needed more than ever. And now that we can be omnipresent all over Canada with millions of customers and PC Optimum, we're going to add a whole new level of value in this country.
Can you do more acquisitions? Do you plan to be more acquisitive? You mentioned wealth, and that's still very nascent. What can you do in wealth that isn't already being done?
Lots. There's a significant wealth transfer happening in Canada over the next many years and globally. When you look at the demographics and you look at some of the products we add, we can get into the mix in a way that matters for people in a very no-fee, low-fee way, in a very advice-based way. One of the most simple ways they can imagine is when hopefully you and many others try your EQ bank account, right? And you go in,
right up to that tent.
and go to the EQ bank account as a starting point. There's an investments tab. And it doesn't cost you anything to join. Wonderful experience. We have RSP, TFSA, FHSA.
You already have that.
We have the day-to-day accounts. We have GICs. We don't have a higher yielding option yet. So if we can even have integrated in, aligned to people's aspirations, even a higher yielding EQ passive investment options as a starting point, integrated into the same experience. And now you have payments, PC Optimum, lending, mortgage. You can be a great choice. And then you can also stop in a pavilion, get your milk and groceries.
You really mapped out my day.
Stop at Shoppers, stop wherever you need. It's all part of the ecosystem. And people want that. And they tell us they want that.
So that's organic growth to me. That doesn't suggest.
Depending if you partner or build it.
Okay.
So we could buy a company or we could partner to put that in the lineup. And otherwise there are acquisitions because we represent white space. We do have an asset manager that's more specialized in alternative. We do have a large trust company focused on credit unions. But people would want to work with us because we represent access then to millions of Canadians. But we're not about mutual funds. We're not about high fees. We're about low fee, innovative solutions for Canadians. And that's what we can integrate in. And we certainly have the capital and the ability to do it.
You've talked a lot about being Canadian, proud Canadian, Canada. I've heard you call this PC financial deal like a Mission Canada moment, teaming up with Loblaws. Let's take a moment and talk about Canada.
Sure.
And how you as a business leader view what is in store for us as a country. And that feels like a loaded question, right? Outside of your optimism of the business, I'm sure you and your other C-suite peers talk about how there are problems in this country and we need to get out of our own way in a lot of respects. What is most pressing to you in 2026? What would you like to see Canada achieve this year?
Urgency. Urgency applies to our business. Urgency is something I've spoken with about our board, our teams, and it comes back to the word complacency. I think too many times Canadians are more complacent than they should be about their money, about their jobs, about their country. We need to take hold of our destiny more in our country. We need to move faster. We need to be more thoughtful across provinces. We need to take action at a much faster pace because what's happening globally from a macro perspective in the US, it's not going to slow down. I think this is going to be the norm for a long period of time. And you have to move to increase productivity as Canadians. So that's on my mind a lot. How do people become more productive? How do they move faster? That applies to all the businesses as individuals. I think we have to pick up the pace and put more kind of points on the board, even as our country, and step up for ourselves a little bit more. And it's always the cliche statement, right? Kind of Canadians are too nice or it'll just happen. We need to take hold very fast. Like, look, the changes I drove in my first 100 days as CEO, I did that deliberately because
Did you face a lot of pushback?
Some, because that's the biggest change and the fastest change we've ever had. And now we've just transformed the entire future of the company within months. But that's necessary to compete and win as individuals, as companies in this country, as public companies, and as a country. So do I worry about Canada? Yes. But am I very optimistic? Yes. We have the resources, we have the talent, we have the brains, we have the support generally globally. But the drawback, and I've seen this when I've worked internationally, even at OpenText, right? People don't think about Canada as much as people think they think about Canada. You know, we are that nice place up north, but we need people to think about us. They need to know why they should invest in our country, in our companies, in our people. It's brilliant people in Canada that care deeply about the world. So I'm a little bit worried that we're not moving fast enough. I think a lot of people are talking about that. I believe there should be some steady continuity in the economy, but I think we need to move faster.
And what does that mean in relation to, relationship to the U.S., like the fact that Prime Minister Carney is traveling the world, trying to diversify our partnerships. Is that a step in the right direction? Is there something we can do to be tougher with the U.S.? I mean, you see on the ground floor, trade is painful for certain parts of this country. And with the U.S. President Trump calling the trade agreement that we have irrelevant, that is scary to a lot of people's livelihoods in this country.
It is. I do believe it's constructive. I've never sensed more of a sentiment of Canada strong, of improving competition, improving the productivity of Canada since the past several months. I do think the government's doing many of the right things. I think it's just seeing some more results here.
And honestly, CEOs speaking up, I've been interviewing CEOs for a very long time, and there's a difference between how Canadian CEOs talk and U.S. CEOs. Jamie Dimon's going to tell you this week, I don't like that cap, that interest rate cap. And even, pipeline companies in this country kind of were polite about the fact that a pipeline wasn't built when it's like existential to their business. Like, do you feel like that's changing? Are you having conversations?
It needs to go faster. It's exactly what we're trying to do. I know I keep bringing it back to Canada versus global. This is exactly what we're trying to do for people to realize. As a challenger bank, we need the support of the government to be more competitive. We need the same capital treatment. We need a lot of things leveled so we can do better here. That puts more money in businesses' hands, in small businesses' hands. We have the most innovative small business offering in Canada, more Canadians' hands, so they have more money to be more resilient. But people need to pick up the pace and stop being polite. It's not, every country's different, but I think that assertive, aggressive nature can do well for Canadians. Stand up for it, absolutely. Take charge, be very proud of this country. And so it's in the right direction, but it needs to move faster. And I'm trying to do that and contribute to that however I can. But urgency is even going to be one of our cultural norms. Focus, one of our norms. Don't get distracted with a bunch of things. Focus on the big things as a country, in your household, in companies you invest in for your future. It'll pay dividends, but go faster. Nobody has time to wait. I even found that in my career. I was like, I'll do that for a few years, do that for a few years. I think I had 15 jobs in 18 years at Scotia, worked through the bank, and I was trying to disrupt even there. Right? But here, I don't think things fit into any box anymore. You need to redesign, rethink, and move fast. And some people might disagree with me. I think some might agree because none of us can predict what's happening. But if you don't, it's going to happen around us. And that's the same thing that's going to happen to Canada.
Chadwick, it's been a pleasure getting to know you and talk a little bit about the business. Thanks so much for joining me.
Thank you so much for having me. I'm very excited about EQB, excited about Canada, and look forward to welcoming hopefully many more customers and shareholders.
That's Chadwick Westlake, the CEO of EQB. Don't miss our next interview. We've got David Picton on the show of Picton Investments, rebranded. It's one of the biggest hedge funds in this country, and we're going to get access to his mind and his approach and his outlook for 2026. So we'll catch you on the next episode.